Hi, welcome back to my channel, Preparing for Retirement. My name is Martha, and on this channel, we talk about everything that I'm doing to prepare for retirement. I will be retiring overseas in January of 2026, and so the time's approaching quickly, and we're trying really hard to get everything put in place and tied up here in the States so that we can be ready to go. I've set a goal of 750,000. And most of that, not most of it, some of it will come from when I sell the house. My husband and I sell our house, but we're going to get there. We're going to get there. It looks like right now, according to the software, I'm projected to reach that balance. So anyway, today I wanted to talk about what's going on in December for me, which is a lot of income. Um, So I know that it's really hot right now to talk about dividends, and the covered call funds are really hot, and everyone wants to become a dividend investor. Well, I want to talk about another way that you can earn income with your investments, and that is through tried and true mutual funds. I happen to have several mutual funds that I've had for probably about 20, 25 years and they have performed absolutely fantastic for me. They give me capital gains income every December, sometimes twice a year. And because I hold these in my tax advantaged accounts, they're either in a Roth IRA or in a traditional IRA, I don't have to pay any tax on them yet, or in some cases, at all. So So I want to talk a little bit about those and just kind of show you, a couple of them and show you what my December has been like so far. I have not gotten paid on all of them because the majority of my funds do pay out on or around December 31st. So I haven't seen the income yet. I don't know what it's going to be yet, but what I've seen coming in has been fairly decent considering the strategy of that fund that I got it from. So I'm pretty pleased. Also, I did do a little bit of rebalancing towards, I think it was January or February. I did get out of some of my software funds. I was very, very heavy in tech, and I was getting a little uncomfortable about that. Um, I still have a fairly generous tech allocation, but I feel a lot more comfortable with, 36% or so than I do with what I had, which I think was around 50 or 60. It was very uncomfortable. So I sold a bunch and I redistributed into other industries like healthcare and energy. And I bought some of the covered call index funds to give it a whirl. And you can see right here, I have my allocations. So I think I'm pretty diversified at this point. I have a higher risk tolerance perhaps than some people my age, and so I don't have tons and tons in bonds. I do have some bond funds, but I don't have a ton in bonds. I do have quite a bit in some mutual funds that have been around, like I said, for 20 plus years, and so I'm really not that concerned. So you can see I have some Vanguard, some Janus Henderson, some Fidelity, and some of these, like I said, I have owned, oh golly, for at least 15, 20 years. So I'm feeling pretty good about those. So as you can see, I did go ahead and get a subscription to Snowball Analytics, and it has been tremendously helpful for me. Before I was using my spreadsheet, which I think I still have it up. Yeah. Before I was using my spreadsheet that I was updating every day, and it just gets to a point, it's very informative and I like my spreadsheet, but um, it is a manual task to update it. So to go to Snowball Analytics was very welcome. I will tell you that when I connected Fidelity, which is where I have the mm, about two-thirds of my cash, when I connected Fidelity, I had to scrub the whole thing. And I learned the hard way that the best way to do this, if you've been with Fidelity for any period of time, which I have for almost 10 years now at Fidelity, we moved over, consolidated from Smith and Barney and all these other places. Um, if you've been with them for any length of time, you really need to download the activity statements and upload them into here. And then once you've brought all of the statements that you can get in there, then you sync it and connect it to Fidelity. And then it will, going forward, it will pull everything in for you. Um, but when I first saw it, I thought, oh my gosh, I can't work with this, that nothing came in correctly. And it just, it was a mess. So I suggest when you set it up, if you're setting up with Fidelity, definitely do the upload option where you upload your activity and go from there. So anyway, as you can see, we're down. We're down. I think I'm down about $6,000 today, maybe more. 2.65%. The market is, it went down today. Um, there was a Fed rate drop cut, which we expected, and it was the amount we expected. But what we didn't expect was some of the remarks that Mr. Powell made afterwards and kind of sent the stock market reeling. So anyway, we'll recover from that. I'm not too worried about it. And honestly, what I did was I saw the direction everything was going in, and I thought, fantastic time for me to buy some more of those mutual funds that I really like. So I bought a couple of them that follow the indices because, like, I bought one that followed the Russell, follows the Russell, because that one tanked. That one just tanked. This major adjustment today. So I'm going to get a really good price on that, and then it's going to come back again because, that was a reactionary thing. I don't think it was based, I think it was based on sentiment and reaction to his speech. I don't think it was based on the analytics. So that's coming back. Anyway, so let's dive in and talk about how I make my money. So one of the reasons why I like um, I like Snowball Analytics is that it gives you a dividend calendar. So right now I have this set to 1 year ahead, and it's already going off what's already been paid and what's estimated, what's declared for December. And then you can see that I've already had a declaration for March, one of my quarterly stocks. I think it was, I don't know, might have been Pfizer. I don't remember. But you can see that it has an estimate based on the stock it's or fund, the schedule for the distributions, excuse me, not contributions, distributions, and um, and then they base the estimate on historical data. So right now, I'm doing really well. I don't have everything in dividend stocks or funds. I have quite a few growth mutual funds. Um, and I have, as you saw, some bonds. So I'm pretty pleased that I'm getting a high rate. Now, one of the reasons why I'm getting such a high rate is because I did decide to play a little bit with a portion of the fund in covered call funds. I tried to be very, very careful in what I chose and didn't go nuts, but it still has grown very fast. I think my initial investment is somewhere around 43,000, maybe 43. And that was in August. And so it's already grown to a point that I'm very uncomfortable with it. I welcome the income, but I don't want a bunch more. I took it off of drip. I'll put it that way. Took it off of drip. And what I'm going to do is I'm going to reinvest part of the dividends back into the stock that it came from or the fund that it came from. Um, and the rest of it, I'm going to go ahead and use it and buy either growth funds or ETFs, or I'll be buying some mm, perhaps more. I don't know how to describe this. I'll buy some more established dividend stocks that aren't quite as risky as these are, a little bit less aggressive. So I'm real pleased with what it's been doing, but I just feel like if we have a crash, I'm vulnerable there. So at some point, I continue to watch um, the nav rate and make sure I'm not experiencing nav erosion, which I think I'm only experiencing it in one smaller one. The rest of them are actually growing, which I was pleased to see. I don't know how they're working their magic, but they're working it. So if I start to see too much nav erosion, I will go ahead and sell that ETF off, and I will probably buy some more conservative dividend stocks. um, I have quite a few at this point, so I can sell and invest in those. But anyway, so that is why this is um, this is pretty high with the amount that I do have invested in dividend stocks and in funds and ETFs that pay dividends. So as you can see, what it does, I've got it for 1 year ahead, and here we have what actually happened each day in December. And you can see right here, we have, this is actually a capital gain and it's mischaracterized, but I can't change it. So I'll just learn to live with it. But not all of my capital gains are showing in this calendar. That's one that happened to be uploaded. And so that may have to do with it that it's showing here because it was uploaded. But I do have, you know, quite a bit of money that has come in. And then, of course, today is the 18th. There are dividends that don't show that came in today, or excuse me, not dividends. There are capital gains that are not showing in the calendar that came in today. And I think there were some capital gains possibly Monday that came in, and they didn't populate to the dividend calendar. So I have hope that it's not going to do that because I really don't want it to influence my averages when I'm looking at this. Someday we would like to possibly be able to live off of dividends. And so I want to get a realistic picture of what we see. Capital gains are, you don't know from 1 year to the next what you're going to get. So I don't want those in here. So you can see that I do have some of the covered call stocks. Um, Here's QDTE and XDTE and RDTE. So I have a few of them. But today I did buy some JEPQ, which I'm kind of excited about, just a small stake. That one's fairly tame compared to those others, so I'm just watching them. But you can see that I have Enbridge and I have Pfizer, and I have a little bit of JEPI, as you can see by the amount. And then I have Spider High Yield. So anyway, um, so I'm going to show you what I've gotten so far in my capital gains, and then I want to show you a couple of funds. So I just have to search by, okay. So you can see it isn't showing any capital gains coming in since the 13th, which I know I've had some this week, so they should come in soon. If not, I'll have to enter them. But you can see I've got $650 there, 320 there. I've got 430 there, 240, 342. There's the 1164. Okay, and that's as far as we go for December. Now, remember I said that most of the funds that I have actually pay their dividends on or around the very end of the year. So after Christmas. They may declare before Christmas, maybe, but most of the time they declare either the day of or a couple of days before. There's been a couple of funds where I find out about the distribution amount per share after I've already got it in my account. So that's kind of funny. But anyway, so so I do make quite a bit off of these mutual funds. And again, I haven't done anything to them. This is the true definition of passive income. I invested probably 20 years ago, and I just get money every year. I think it was a couple years ago, maybe 2021, one of my funds paid $10,000 in capital gains. And I think it was a software fund. Like I said, I I was getting a little uncomfortable at how tech heavy I was, so I sold off about half of that Fidelity is a Fidelity Software and IT Select Fund or something like that. But I sold off half of it around January or February when I rebalanced. So let me show you a couple of the funds that I really like, and they've been around for a very long time, and I've had them for a long time. So here's the first one, Janus Henderson Enterprise Fund. Um, as you can see, it was established in 1992, and you can see the hypothetical growth of 10,000. It only goes back to, into um, 2015, I think it is. It's a 10-year. But you can see here, it's in purple. So you can see that it is outpacing uh, the Russell Mid-Cap Growth Index and the Mid-Cap Index, and then the Mid-Cap Growth sector. So, it's performing really, really well. You look at it, it's a 4-star according to Morningstar. And then the performance over the last year, it's almost 31%. Over the last 10 years, it's almost 13%, which is absolutely crazy for the way that this fund is set up. It's had tremendous growth, but it also has very generous distributions. So I'll show you those. Here we go. Now, this rate was before the end of day today. So I haven't seen what the new rate is, but um, I bought this for, let me see, one fund. My average cost basis is $90. And the other account that I hold this fund in, the average cost basis is $47. So that's how long I've owned this fund. I've owned it for a long, long, long time. It is a little bit spendy. At the time when I bought it, you didn't have all the low expense options that you have now. And this one has been so good and is so highly rated that I will deal with it. I will be able to handle that amount of expense for what it gives me. I just want to show you, I got a capital gains payment, 2024, December, $8 per share. $8 per share. And then at the same time, I also got a dividend for $1.37. So you're looking at almost $10 between the capital gains and the dividends per share. So it's running right around 6 or 7% for a return this year. You look at last year, it was $9.08 per share capital gains. There was no dividend. The 2022, which was a horrible year, this did great. It paid $12.50 per share. So, I love this fund and I'll be buying more of this fund. Um, well, I buy more of it every year when I reinvest my capital gains, but this is just a fantastic fund. So highly, highly recommend this fund. The next one I want to show you that I've owned for a long time is Winslow Large Cap Growth, Class A. This has been in existence since 1995. I love the old mutual funds. I love them. They've got a long history. They'll show you how they do in a market downturn because it's been through the dot-com bust, it's been through 2007, it's been through 2022. It's been through some stuff, right? So with some of the covered call funds, I get a little bit nervous. I'm like, what if there's another dot-com bust? Because I lived through the one in 2000, my husband and I, and he was in IT. So it was just traumatic for us. We lost it all. We lost everything. We had to sell our house because we couldn't pay for it. He lost his job. We lost all our savings. Everything gone. It was very traumatic. I don't want to go through that again. So the covered call funds, you're going to take a hit during a downturn. You just are. So I keep that in mind as I am investing in them with regards to what amounts I do. I try to diversify between all kinds of different things. I've got a lot in indices, cover call, covering indices. But these funds that are older, these older mutual funds, you can see how they fared and they did well. So anyway, let's get on with it. So this one is also spendy. Again, it's older, but look at that return. 1-year return, 37.6%, and a 10-year average return of 15% per year. That's just crazy. That's just crazy. And look at how inexpensive it is, $9.90. Just crazy. Let me show you some of the distributions over the past few years. So we've got no dividends happening, but the capital gains are coming once a year, and everything from $2 to $1 to $3. If you look at the NAV price, that's a great return. That's a fantastic return for doing literally nothing. It's 4-star and Morningstar, which also means something to me. No transaction fee. I do have a couple of mutual funds that have transaction fees, but the Janks and Mille Lacs are not those. They do not have transaction fees. So real pleased with this one as well. I recommend it highly. And again, I have it in tax advantaged accounts. So it's been a good one. Next one is one of the Fidelity accounts that I've had for a very long time. Fund Inception, 1985. Another 4-star and another no transaction fee. This is select retailing. As you can see down here on the hypothetical growth of 10,000, it's outpacing the S&P. That's just crazy. That's just crazy. So this has been a fantastic fund for me. The average 1-year return, 32%. Over the last 10 years, almost 15% again. This is just a great fund. And if we go and look at the distributions, you can see it has a lower expense ratio. It's not low, but it's lower. And then the capital gains history is decent. It's respectable. So I haven't gotten the December one yet, but you can see that it pays out capital gains 2 times a year. So already in the last 12 months, I've made 250, almost 260 in capital gains. And then I'll also have a dividend here that'll pay out. So I'm real pleased with this one as well. Again, 4-star for Morningstar's uh, rating system. So I like this one. I also have a couple more to show you that I bought today. I did mention that I see today as a buying opportunity when the market drops like that. It's a buying opportunity. So this is not the updated price. It's going to be lower than that because I think the NASDAQ went down 3%. I want to say 3%. And the S&P went down almost 3%. It might be more. It might be more. But anyway, that's going to be down. So this is the Small Cap Growth Index Fund. It's established in 2019. That's a little bit younger than how I like them, but I'm going to go with it. The expense ratio you can see is low. It's 0.05. It's not as high a rating on Morningstar, which I'm usually a little bit more selective with this, but I didn't put too much in, so I'm going to see how it goes. You can see here it is matching the Russell 2000 growth. So I would expect that for a growth stock, or not stock, excuse me, fund. You can see in the last year, it's grown almost 41%, which is insane. And then over its lifetime, it's got almost 9.5%. So that's fairly decent. It made it through 2022, which is where you see the 3.45. You can look at the composition here, and you can see that we're mostly healthcare, industrials. It does have IT, consumer discretionary. And as it's named, it's a small cap growth. So it's exactly as it purports to be. You've got your top 10 holdings down here. Um, it's mostly almost all United States and almost all equities. So the last thing to look at, I wouldn't expect to see much for distributions, and I don't. I don't see hardly anything because this is small cap growth. So I got a small amount of that on sale today. And then I also got this one. the Fidelity Zero Large Cap Index Funds. Fidelity has this new family of funds. Well, I don't know how new they are, but they're um, oh, not that new, 2018. But there's zero fees. So literally zero expense ratio, and there's no transaction fee. And I thought, hey, let's take a look at these. And so I went in and I found this one, Morningstar rating of 4 stars. And it's got an annual, the 1 year return is 34.5%. Over its life, it's got 14.5%. And if you look right here, it is nested in with something. Let me see. Okay, so it's nested right in. It's matching exactly. If I take off the large blend sector, yeah, you only see the one line. So it's exactly matching the Fidelity US Large Cap Index. So it's just a powerhouse. It's just a powerhouse. So I already had this in another, I just bought a little bit in another account that I have for my grandsons and not much. And so I liked it so much, I thought, you know what? I'm gonna get some more of this. So the composition is exactly what it purports to be. It's a large cap index, so it's a blend, but it kind of tends towards growth historically. So right now it's a blend, but you can see it's heavy in IT and financials, and that's basically because large cap right now it's probably weighing into um, look at the larger companies right now. Nvidia has has a huge market cap, so it's going to be a little bit tech heavy just given the markets these days. It's almost entirely domestic equities, and there you go. Apple, Nvidia, Microsoft, Amazon, Meta, Alphabet, Tesla. So, this is all the big boys. So this is a way for me to invest in them without having to, bite my nails over the stock price in Nvidia. I sold my Tesla too early. I'm kicking myself. I saw a 55% gain and I was like, oh, I'm taking that win. And then it immediately doubled. But Nvidia, I'm hanging on to, and I don't like owning single volatile stocks like that. So let's look at the fees and distributions, and you can see there's almost nothing, which is exactly what I would expect from this kind of fund. That's not why I'm buying it. I'm buying it for the growth. So, why would I buy growth instead of dividend producing? Well, first of all, I'm buying both. I'm buying some of my funds going to dividend producing ETFs, funds, and stocks, and some go into growth. With the growth, what I can do when we get to that point, if I need the income, I can sell these funds after they have grown exponentially. And at that point, I can buy dividend producing instruments that I can then live off of without touching the principal. So that is why I decided to split my DRIP now. So I'm only reinvesting half of the dividends that I get on the covered call funds. For all my other dividend producing instruments, they're still on DRIP. But the covered calls, I don't want that getting too much larger. I just don't. So I'm going to go ahead and watch it for NAV erosion. I'm going to watch it for I like the WiMAX. I bought WiMAX and I'm like 3% up on that in terms of the share price since, well, not today, actually. Probably only 1% up. But I'm up on the share price since I purchased it in August. So, I can't complain. I'm not seeing NAV erosion. Now, whether or not I will over time, I've got a spreadsheet and I will be watching that. And if that does happen, then I will go ahead and I will divest and I will get into, JEPI or JEPQ, something with a longer history, or I'll just go ahead and invest more in the dividend producing stocks that I have that are not CC funds, covered call funds. And I've got a bunch of those. I've got some Kraft Heinz, I've got some Pfizer, I've got Enbridge, I've got SCHD, I've got, some Spider um, funds, I've got Realty Income. So I've got a variety. Um, I've got an AI fund. I've got a pick is commodities, materials, I guess. I don't know how you classify it, um, but I have a variety that I get paid on mostly every quarter, actually. I would in no way, shape, or form call NVIDIA dividend stock. There you go. I got 7 cents. Um, but if it gets to that point where I'm just way too uncomfortable with the covered calls, I'm going to go ahead and get out of those, or at least greatly lessen my allocation. And at that point, I'll be more, I'll be closer to the actual retirement date, and I'm probably going to do the bucket strategy. Well, I'm not going to probably, I'm going to do the bucket strategy where I have enough money for the first uh, 2 years. I'm going to do 2 years in the first bucket, and that will be fairly liquid. There may be a CD ladder, something like that, with majority in cash. And then after that, I'll have some longer term, either T-bills or maybe some tips or more CDs, depending on what the rates are. Um, and then after that, the rest will be in the market. So I'm going to have the first 7 years. After 7 years, we both get Social Security and our bills are covered. And so at that point, everything can just grow and I can just have everything on drip. So anyway, that's where we stand. But I hope that you liked some of these dividend funds that I showed you today. They're the oldies but the goodies, most of them. And I really like the ones that I have. And as I continue to get paid towards the end of the month, I will do another video that shows you some of the rest of them. They're mostly Fidelity funds, not all of them, but most of them are Fidelity funds. So maybe it'll make you take a second look at those old funds, and maybe there'll be something that'll really help round out your portfolio. So anyway, don't stress about the market. Look at it as a buying opportunity. And other than that, have a wonderful evening. Bye.